Good morning, Wall Street winners. It is July the 24th, Thursday, and this video is about considerations during earnings periods. So we had some, my dog gets very excited about earnings. We had some earnings periods. We're in an earnings period, and we had some earnings last night. So let's talk about one of the earnings we had come out last night, and that was IBM. And IBM posted fairly good results, actually, but maybe not as strong a go forward or future prediction statement for the next quarter as the markets wanted. And it sent it down almost 7%. As you can see, it's down almost $19 in the pre market. Now, if you scroll down a little bit lower in Yahoo Finance here under IBM, you'll get to the summary of key statistics. And one of the things you want to pay attention to is over on the left-hand side, known as the P to E ratio or price to earnings ratio. So here's a company that is trading at 45 times, 45 and a half times its price future earnings. So it's price to future earnings. That's a pretty high multiple in many cases. I mean, the average has creeped up over the last 10 and 20 years. And I don't know the exact numbers, but I want to say it's in between, say, 18 and 24 is kind of the new median where things have settled at. So anything with a price to earnings ratio that falls within that 18 to 24 is probably priced reasonably, we'll call it. But this is easily double that, if not a little bit more than double that average. And the growth rate of IBM is low in general. So it's really hard to justify a price earnings multiple that high when you're not growing your revenue and hence your income and your free cash flow. Whereas if you look at a company as an example, like Google has reported earnings yesterday. I didn't mean to click on that. And if we scroll down here, it has a price to earnings ratio of 20 and a half. So this is a company that's growing quickly, growing significantly, growing at double digit multiples in the 20-ish growth rate, 20 times growth rate year over year. This company can justify a higher price to earnings ratio. Now, on the flip side, when you do get a growth company, you'll notice on the forward dividend and yield on the right at 0.44%, the dividend on Google is far less. And in a lot of tech companies' cases, doesn't exist at all. So there's no dividend payout. Whereas if we go back to IBM, you'll notice that the dividend payout on IBM is 2.38%. So you're getting a little bit of, call it security or income through the dividend distribution and payout, but the trade-off is lower growth. And with that should be a lower price to earnings. So I wouldn't be surprised if we see IBM pull back even further. I think it's gotten a boost due to the AI narrative and its involvement in AI, but I think it's over justified in comparison to others. So when buying into companies prior to an earnings release, look at the price to earnings ratio and see whether that ratio falls within the comfort zone that you're willing to accept and is justifiable from a growth perspective. Good luck in your trades today. And if you like the videos, please hit the like and subscribe.